In this video, we will intuitively understand put options. A put option is an agreement between the buyer and the seller of the option. It gives the buyer of the option the right, but not the obligation, to sell the underlying asset at a specified price within a specified time. For a better understanding, let us use the analogy of an insurance for a put option. Suppose John buys a car worth 200,000 rupees. John goes to an insurance company and buys an insurance for the car. He pays a premium of 25,000 rupees to insure the car for a year. Let's say he met with an accident and the car was completely damaged. Now, he ups to claim for the damages and in turn receives the insured sum of 200,000 rupees from the insurance company. This is almost exactly how a put option works. Let us look at the corresponding payments for a better understanding. Here 200,000 rupees is equivalent to the strike price, 25,000 rupees is equivalent to the premium, and 1 year is equivalent to the time till expiry date. In the put option, when the price falls below the strike price of the option buyer will exercise the option and pocket the profit. Let us try to understand how it actually works. Consider two traders, Mac and Chris. Chris is of the opinion that the current share price of Infosys, which is trading at 900 rupees, is overvalued, and expects the price to decrease in the future. However, Mac is of the opinion that the Infosys share price is valued correctly, or that it is undervalued. Based on their beliefs, Chris decides to buy the put option, and Mac decides to sell the put option. To buy the option contract, Chris pays a premium of 10 rupees to Mac. Let the strike price, X, be 900 rupees and the time to expiry, or exercise, date be 3 months from now. Now, let us understand the effect of the underlying price on the profit and the loss for both Chris and Mac. Suppose the stock price drops to 800 rupees. In this case, Chris buys the stock from the stock market at 800 rupees and sells it to Mac at 900 rupees, the strike price. According to the agreement, Mac is obligated to purchase the stock of Infosys at 900 rupees from Chris. Mac then goes to the stock market and sells the Infosys stock at 800 rupees. So, the net profit for Chris is 90 rupees. That is 900 rupees minus 800 rupees minus the premium paid of 10 rupees. Similarly, the loss for Mac is 90 rupees. Now, assume that the price rises above the mark of 900 rupees. Then, Chris will not exercise the contract, since he has no obligation to do so, and loses the 10 rupees paid to Mac as the premium. Similarly, Mac profits 10 rupees received as the premium. Now analyze the payoff diagram of the long put and the short put. Here, one important thing to note is that the put buyer has an opportunity to make huge profits, as the price of the stock can theoretically fall to 0 rupees, but the put seller has his profit limited at 10 rupees.